Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the Cost Accounting Explanations 3, Costing Variances 104. Hope you will like, share and special request to all to don't forget to subscribe our channel. Costing Variances 104. Costing variances. Variance analysis is the process of comparing the actual expenses and revenues during a certain period to the budgeted amounts for that same period. Variance analysis shows management where the differences are between actual and budgeted amounts, enabling management to investigate to determine the reasons for the variances. Knowing the reasons can help management to focus its efforts on the areas that have been operating less efficiently than planned. A budget is meaningless unless actual results are compared to the planned results for the same period. The budget needs to be used to monitor and control operations to meet the company's strategic objectives. The comparison between the actual results and the planned results is called variance reporting, and it should be taking place at every budget unit level. The actual production will most probably be different from the budgeted production, and the actual costs incurred will most probably be different from the budgeted cost used to determine the allocation of the overheads. The difference between the actual overhead cost incurred and the overhead cost applied to production is called an underapplied or overapplied overhead cost, also called as a variance. At the end of each accounting period, variances are accounted for in one of the two ways as below. If the variances are immaterial, they may be closed out 100% to cost of goods sold, that is COGS, expense on the income statement. If the variances are material, they should be divided proportionately on the pro rata basis among cost of goods sold, that is COGS, and the relevant inventory accounts on the balance sheet. Generally, finished goods and work in process inventories, according to the amount of overhead cost included in each of the two accounts mentioned, that is COGS and inventory, that was allocated to the current period's production. If the variances are closed out 100% to COGS, the inventory cost of the units produced will be equal to the standard cost of the units only. Increasingly, companies are using enterprise resource planning, that is ERP systems, to help them track standard and actual costs and to assess variances in real time. The manufacturing variances calculated will be affected by which cost measurements method is being used. Effects of standard costing on variances reporting. Standard costing guides as a measuring rod to the management for determination of variances in order to evaluate the production performance. The term variances may be defined as the difference between the standard cost and actual cost for each element of cost incurred during a particular period. The term variance analysis may be defined as the process of analyzing variance by subdividing the total variance in such a way that management can assign responsibility for substandard performance. The variance may be favorable variance or unfavorable variance. When the actual performance is better than the standard, it represents favorable variance. Similarly, when actual performance is below the standard, it is called as unfavorable variance. Variance analysis helps to fix the responsibility so that management can ascertain A. The amount of the variance, B. The reason for the difference between the actual performance and the budgeted performance, C. The person responsible for poor performance or the department responsible for poor performance, and D. The remedial actions to be taken. Types of variances. Variances may be broadly classified into two categories: cost variance and sales variance. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounts and Finance with FARSK. Thank you. Have a great day.